We often hear about how, let's say, elevated interest rates impact consumers' ability to turn over their debt, pay down their debt, obtain new debt, buy things they don't need, but also to acquire credit, i.e., debt, to buy things that they do need. I am definitely not a low interest rate guy. I think we need normal rates for an economy to be healthy and to grow. However, as you know, the pressure is on right now against the Federal Reserve to cut interest rates. They're getting bashed, weekly by the Trump administration to lower rates, and so far have been standing pretty firm that the time is not now. And I believe at this next meeting, you're probably going to see, I think there's a 98% chance that the Fed's not going to lower rates at the next meeting either. But what we don't often hear about, or let's say talk about, is the effect that, let's say, higher for longer, if you will, interest rates has on corporations. So out of Reuters today, Deutsche Bank is sounding the alarm. And Deutsche Bank says the rate at which riskier U.S. companies' defaults will increase next year as a result either of a weakening economic growth or the pressure of higher interest payments. So, of course, corporations take out debt to, let's say, fund operating costs, to fund inventory, et.cetera., and they're repaying that money at higher rates. The investment bank sees default rates for U.S. says speculative grade companies, also known as high yield or junk, rising from its current 4.7% to 4.8% by the second half of 2026. You might say, well, that's no big deal, but it is, because there are more failures. Part of the reason is tight monetary conditions, because the Federal Reserve is not cutting rates. Deutsche Bank says the 10-year yield, listen to this, will soon rise above U.S. nominal GDP growth for the first time since at least 2011, excluding the pandemic period. Growth is slowing, and Deutsche Bank sees a 30% chance of recession. While the U.S. 10-year yield is currently around 4.5%, I saw it pull back a couple of basis points today. How many of you think that we're already in a recession, right? Not that there's a chance of a recession. Many of you that are experiencing a lot of economic pain right now certainly believe that from your personal perspective, you are in a recession, and maybe some of you are in depression. It is expected to remain elevated given the Fed's concern about inflation, which makes it cautious, it says, about cutting interest rates. The Fed is unlikely to provide rate cuts before job cuts. Listen to that. The bank says the Fed is unlikely to provide rate cuts before job cuts. And, you often hear that the Fed will wait or does wait until the employment picture is a complete disaster. I would argue it's already pretty bad, but they wait for it to get atrocious, if you will, before they step in. Either weaker growth and or higher rates should prevent U.S. defaults from falling in 2026. So again, what they're saying is that defaults are going to continue to rise. Why is this important for the man or woman on the street? Because whether it's a junk type, a corporation or not, these companies are all repaying debt at higher rates, and it has an impact on the bottom line. It also has an impact on their plans to continue cutting positions, right? So it all flows down to everybody. If you guys are clocking in, a 9 to 5, and the company you're working with is suffering under a lot of debt load, and the rate, and they can't refinance that debt, right, to get it under control, to come in line with their budget needs or expectations for the coming year, guess what? You're going to see more layoffs, more job cuts, more consolidations. So Deutsche Bank, one of the biggest banks in the world, is parroting this sentiment for the U.S. corporations And basically, they're sounding the alarm as to what's going to happen with the U.S. economy. Okay, let's talk about another article I saw in Zero Hedge today, or a second article, talking about consumers. And that's a topic that I raise oftentimes on this show, as you know, and I try to highlight things I see. It's almost like I guess I'm preaching to the choir a little bit, because a lot of you understand you're feeling the pain on a daily basis. But sometimes I think it's cathartic, if you will, to hear some of this stuff, understand that you're not alone in this struggle, you're not alone in this fight. So this says retailers offer Goldman Sachs, another big bank, a consumer reality check as one thing it says remains clear. This is out of Zero Hedge today. With just 3 weeks left in the second quarter and the summer session in full swing, a key question emerges. What is the status of the consumer? Goldman Sachs analysts Kate McShane, Mark Jordan, and others published a note on Monday offering valuable insights into consumer trends following meetings with the management and investor relations of Dollar General, Dollar Tree, Five Below, Leslie's, and Ollie's Bargain Outlet. I don't know, I've never even heard of Ollie's Bargain Outlet. Love to hear your thoughts or your input below. Do you guys have that in your area? It says this comes as the first half of the year was marked by market turbulence, sliding sentiment, and escalating trade war tensions. McShane's discussions with the management teams of those companies I just mentioned, I won't list them again, painted a picture of cautious optimism. So I'm going to again put it out to all of you guys. Are you cautiously optimistic about where things are heading? Are you pessimistic? This is while companies are seeing pockets of resilience, persistent economic pressures, particularly elevated inflation and interest rates, again tying back to rates, continue to weigh heavily on discretionary spending, especially among the working poor segment. And the article continues, longer form takeaways from the meetings with those companies suggest that consumers are increasingly seeking value as retailers navigate ongoing challenges, including inflation, tariffs, and the shifts in consumer spending behavior. And why is there a shift in behavior? Well, the main reason from my perspective is consumers have to go cheap. They can no longer afford to spend like they used to spend. Now, some still are, right? Some are still doom spending, spending like the old drunken sailor adage you hear about, but they're using credit cards to do it. And that's going to come back, obviously, to end very badly from my perspective. It says the analysts also provided a snapshot of the Broadline's Q1 results of the retailers, and they give a chart of that. I won't go into it. It says one thing remains clear. Working class and low income consumers are feeling financial pressure. On the positive side, though, which is not highlighted, it says in the report, falling gas prices have offered some modest relief. However, it's being offset by generationally high credit card interest rates and sticky food prices. Okay, back to the interest rates again, which continue to strain household budgets. Are you guys feeling more of a pinch because of higher gas prices? Is that something that really is factoring into your equation right now on a day-to-day basis? If you are a lower or median income individual, I just feel like some of these articles always look for something to reach to. The reality is consumers just are tapped out. Things are costing too much. They're not coming down. But I think it's more food. It's more insurance prices, costs of homeownership, rents, things of that nature. Don't want to go too long today. I'll leave it there. Back in the office for the week. I've got some mediations, some clients coming in, some business. So I had to depart the coast to come back to take care of these things this week. So I'll be here doing some shows and back in the regular workout routine for the week at least. Then I'll probably be heading back out on Friday-ish to get back down to the coast. I didn't see sun for 8 days. Did not come out. It was totally socked in down in La Jolla, California by the coast. The sun didn't come out at all. I got back up partway today this morning and saw sun for the first time, and now it is 105 degrees here, which of course my body is trying to readjust very quickly to the temperatures. So I'll be living here in a bit to get the workout. Thank you guys for supporting the channel, hitting the like button for me. Subscribe to the channel if you're not subscribed. We are growing. I'm seeing an uptick in subscribers, so that's encouraging. It's easy to hit that subscribe button. It's free, so please do it for me so we can keep growing the channel if you haven't already done so. With that being said, I'll be back tomorrow, and let's see how things continue unfolding. Markets were kind of flat today. If you're watching cryptocurrencies, Bitcoin is back on a roll. Probably going to be making new all-time highs. Not trading advice, not financial advice here in the near future. Silver continues to show, a lot of good gains. I think it closed up about 75 cents an ounce today. Those are big gains on silver. Remember the days when silver would move 1 or 2 cents for it seemed like weeks on end, and now we're having these big upticks. So let's see if it can sustain it. All right. All of you have a great rest of your day, and I will talk to you soon. Bye.